Alright, welcome back. We're doing another stock analysis video, this time on Costco, ticker symbol COST. They have a market cap of $227 billion and are selling for about $513 a share as of last Friday, the 5th of November. So anyway, this is a description of the company. If you want to read it, please do so, but pause the video because I'm going to move on to the income statement. All right, so what we have here is the last 15 years of quarterly reports from Yahoo Finance, and it's just exported to Excel, and we're going to look at these charts. Look at this revenue. Look how impressive that is. Just going up, 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 up. I think, no down quarters at all. That's awesome. So anyway, I always like to look at that, but we're not going to use that for any metrics. So first one we're really going to pay attention to is this gross margin. Y'all know that's what I always... I'm kind of a stickler about. But in this case, I know you see these low gross margins and you think, oh man, you must hate that. But that's how Costco runs. They've said multiple times this is part of their business model. They want to intentionally run at low gross margins so that they can provide a very cost efficient product to the consumer, and they can just gobble up market share by being a great low cost product. So that's their plan. I know this looks like it's jumping around a bunch, but it's really not. It's just moving between 12 and 14. So like I said, this is running as intended. This is nothing to, we don't really need to spend any more time on that. All right, pre-tax income. So pre-tax income is, y'all know, my favorite way to, measure companies' income because you don't have to worry about things like changes in the tax codes or, write-ons, write-offs. So anyway, this is going to be used for our valuation metrics. What we're trying to do is pick what we think it's going to be in the near future, right? So, by this kind of 2023 line. I think following that graph, I think optimistic would be 2 billion. I think 1.8 billion a quarter is not is pretty reasonable. So that's what I'm going to go with. So I'm going to do 1.8 per quarter times 4, and that's $7.2 billion per year is what we're estimating for our pre-tax income. All right, and we're also going to get a growth number from this. So the way the best way to get growth number is to, especially for something like this that's just growing consistently, is to base it off of past growth. So if you look here, 2006, 2007, we were 2005, 6, 7, we're running at $400 million a quarter profit pre-tax, and now in 2021 you're at 1.6. So what we're going to do is we're going to say 1.6 billion divided by 400 million, right, which is $0.4 billion. So you do that and then raise that to the however many years you're trying to get the growth rate for it. So in this case, it's about 14 years. So I'll use 14 years. So 10.4% growth. So put that in the growth section. We're going to use that later. All right, now we're going to earnings per share. So let me put the decimals back over here. All right, so earnings per share. Look, this is growing too. I mean, this is like, it's like going, parabolic on us. That's awesome. So anyway, for this, we're going to just take the sum of the last 4 quarters, so the last 12 months. So I'm going down here, and it's going to be off screen, but I sum this, and I get 1140 for the last 4 quarters. So I'm going to put that over here in the outline, 1140 per share for our earnings per share. All right, so let's go to the balance sheet. So first thing we're going to start with is total assets. Usually I use total tangible assets, but in Costco's case, I mean, it's the intangible stuff is just almost negligible. So we're going to just base it off of total assets, and you're going to see the same thing with return on equity too. So assets are growing. I mean, what we're really using here is we're going to get a pre-tax ROA, so pre-tax return on assets. I've described why we do that in previous videos, so I don't want to repeat myself. All right, so our pre-tax number is $7.2 billion, and we have a total assets of about $50 billion. So, all right, 14.4%. So 14%. That's actually, anything above 15 is really good, and especially just to have your asset asset base just growing like this and still be getting 14% is really strong. So that's great. All right, moving to equity per share. So this is all your assets minus your liabilities divided by the number of shares. We like to see this growing. I'm a little surprised that we had these hiccups here. I'm gonna have to look into that more. I don't know if that's just a data gathering error or if there's something else going on here. But recently, I mean, this is great, right? We're growing share value. That's what we like to see, right? You want to see the net worth per share growing. But anyway, we're going to get a return on equity on a per share basis from this. So all we do is we take that 1140 for our earnings per share, divide by, what is this, 38, divide by 38 for our equity per share. And we get 30% ROE. Also really strong. So, and then finally, we're just going to get the price to book value. So that is the current share price, 513, divided by 38. 13.5. That's extremely high. You don't see too many that high, but I mean, the stock's going to be, by traditional valuation metrics, I'm sure the stock's going to be overvalued, but I think that all the intangibles that you're seeing is the reason why, but we'll get to that in the conclusion. All right, let's move to the cash flow statement. All right, so first thing we're going to look at is free cash flow, and kind of same as the pre-tax, we're going to just try to get an estimate of what we think it's going to be in the next couple of years. So, I think 1.5 billion is not a crazy number, so I'm gonna pick that. Look, this is up for interpretation. Like I say every time, you can look at these charts, you can look at the graphs, you can look at the tables, and you can kind of come up with anything you want to. You're gonna see what you want to see. So, it's important though, because that's what really affects the valuations, is what numbers you put in. So you got to try to be realistic. Don't be too ambitious, but also don't be too conservative, because you'll never buy anything. All right, so 1.5 billion, like we said, per quarter times 4 is 6 billion per year. So $6 billion free cash flow per year. And we're going to look real quick at depreciation versus CapEx. So, and I'll tell you why once we look at it. Okay, so depreciation, looks like we're depreciating. That's how much value our assets are losing on the books every quarter. So it looks like it's about $400 million every quarter our assets are depreciating. And then let's look at our capital expenditures. So where are they? Down here. All right, but we're spending, so we're taking 400 million off the books every quarter, but it looks like we're spending about 800 million per quarter on CapEx, about twice the depreciation. So in general, if you see higher CapEx than depreciation, you better be seeing growth, because if not, then that's a bad sign. So in this case, it's almost a non-issue, because the growth is there. I mean, we see it, but just something to keep an eye out for, because like depreciation is how much your assets are losing value, right? And so if you're having to CapEx, more than what you say that they're losing value, and you're still not growing, that's a sign that it's costing you a lot more money to keep your business running than it should, So just keep that in mind. In this case, like I said, it doesn't matter, because the growth is so good, but I just wanted to point that out. All right, let's go to the valuation. All right, so we got 3 methods: the pre-tax method, the earnings per share method, and a discounted cash flow. So I just want to say before we do the pre-tax one, this is my kind of rule of thumb that's done good for me. I've noticed though it really doesn't do too well whenever it comes to big growth stocks, or stocks with a lot of that's stocks with a lot of growth. So anyway, we'll still do it though. So we had for our pre-tax, what was it, 7.2? So 7.2 times 10, $72 billion is our new market cap, divided by 442 million shares. So we get a share price of 163. All right. Like I said, I anticipated that to be pretty low. All right, next one is going to be this earnings per share formula, and this factors in growth, so this might be closer. All right, so 1140 is our earnings per share times 8.5 plus 2 times 8.5 plus 2 times our growth, which is 10.4. So we get 334 is a share price target. Pretty good. And last one is the discounted cash flow. This is not on the calculator. This is going to be on this table, this graph here. So our free cash flow is 6 billion. Our perpetual growth rate. Okay, usually I say you want to be more conservative with this than the growth rate, but whenever the company's shown such consistency on the growth like we saw here, you're not really risking that much by putting their actual growth rate here. So 10.4, and then I'm going to discount it 15%. All right. So our new market cap that we get is, what's that? Okay, $147 billion. So I'd do 147 divided by 0.442, and our share price is 332 or 333 if I round up. Well, that's crazy. It's right there with the other one. All right, so look, we got 3 metrics. I would ignore the first one just because, like I said, it doesn't do too hot whenever it's trying to evaluate a big growth company. But the other 2, we came in right kind of around the same number, and it's significantly lower than the share price. I mean, it would have to drop, 40% or so to take it to that level. So does that mean that it should be avoided? I can tell you this, it should definitely not be shorted. I think one of the worst mistakes is shorting a good company that's overvalued. I think that's a great way to lose money. Just ask all the people who shorted Tesla, right? So I think that there's a chance it never sees 333 or 334 again. I mean, we saw a lot of intangibles with this company. It's got great growth. People will continue to pay for that extra growth. And that's kind of why I included that quote up there by Peter Lynch, right? The time is on your side when you own shares of superior companies. You may buy it right now for 513 or something, and it could drop to 400, 300, but you might know that in 5-10 years it's probably gonna be 1,000 or higher. So it's just something to keep in mind, But anyway, I hope everybody learned something, enjoyed the videos. If you did, please like and subscribe. And if you have any comments, questions, or requests, leave them below. Thank you.